All right, welcome everyone to the Four Seasons Hotel in Sydney. Thanks for everyone that's attending here in person, and thanks to about 50 or 60 people that are tuning in live online as well. We've got an all-star lineup for you guys tonight. This is our second property investor night. We did one in Melbourne a couple of years ago, and we've decided to run another one in Sydney tonight. The night itself is about how we can help property investors own, manage and develop their portfolios. We've got an all-star lineup of people and speakers to help us go through that tonight. I won't spend too much talking because they're much more important than what I'm going to go through. But if you haven't looked at who's presenting tonight, we've got Tim Lawless, who's Head of Research at CoreLogic, Vincent Turner, the Chief Innovation Officer at Uno Home Loans, Kiril, Ruvinsky, the Director of Strategic Investor Group, and we've got Frenken, who's going to talk to proper property management. I won't, like I said, go through a great deal. So to kick off, I do want to apologise. Joe from Open Agent is a late withdrawal from tonight. There is a family issue that she had to go up to Queensland with, so we won't have someone talking from her space, but we've got 4 other amazing people to talk through their part of the slideshow as well. So without further ado, I'd like to introduce Tim Lawless from CoreLogic, who's going to talk to you for about 15 to 20 minutes.
Thanks, Paul. Good day, guys. Thank you. Thanks for coming out tonight. I'll let you know immediately. I'm a Queenslander, right? So a lot of people tend to hold that against me around state of origin time, but that's a long way off at the moment. My job tonight, guys, is to give you a really quick rundown on what's happening in the market. I'm guessing most of you will be pretty across the trends. Most of the people that come to these sort of events tend to have a pretty keen interest in housing markets and the economics behind them. But hopefully you learn a few things here and there, and maybe the best part of this is going to be the Q&A anyway. No doubt, if anybody's interested in getting a copy of the deck that I'm presenting, just have a chat with the proper guys. I'm very happy for them to share it with any of you, and feel free to share that with your families and your kids. Never too young to start learning about what's happening in the economy and in the housing market, that's for sure. So I'm going to talk about what's happening with housing values for starters. That's generally what most people are here for, but also a few of the other trends that we're seeing in the marketplace, activity, how much supply is around, what's the pipeline of supply looking like, what are some of the challenges that might be ahead of us, what are some of the opportunities as well. I'll keep it fairly focused on the local market here. I'll provide a little bit of context for other markets. Part of, I guess, the fascination of housing markets is knowing how your own market or where your investments are performing compared to some broader benchmarks or compared to other capital cities. So I'll go through some of those other maybe competing trends as well. So let's start with values. And the data I'm using here is a bit of a mouthful. It's based on our hedonic regression index. So to keep it really simple, this is a valuation-based index. So a lot of people are used to seeing things like median house prices and stuff like that. That's down the really simplistic end of the spectrum. A hedonic regression measure values individual properties and takes out a lot of the bias of median. So much less volatility in this sort of methodology, and a much more accurate measure and a much more timely measure as well. You probably know that we have a daily reading on the market, which you can see on our website if you want to. The daily reading is kind of interesting, but I'd certainly be the first one to warn you against trying to annualize a daily movement or anything like that. It's really good for understanding a rolling trend, a rolling 4-week trend, that type of thing. What I've got here is a rolling three-month trend. So you can kind of see what the trends are across the housing market. So the most recent set of numbers is over the March quarter. And you can see once again on this data that Sydney is leading the pack for the major capitals, which is a bit of a new phenomenon. Sydney was actually one of the markets that started this recovery cycle a little bit late. Sydney had a longer and a few more intermittent lockdowns, which did delay this recovery cycle a little bit. Not as much as Melbourne, of course. Melbourne saw values fall by nearly 6% through the worst of COVID. In Sydney, housing values were down about 3.1%. So if you remember this time last year, it was when a lot of people were thinking the sky was going to fall and housing prices were touted to fall anywhere between, say, 20, 30, 40%. Clearly, that wasn't the case. And in fact, we only saw housing values nationally fall by 2.1% on our national index. Sydney, a little bit more than that. Melbourne, a lot more than that. Melbourne was down about 5.6%. But every capital city, as you can see, is on a pretty strong recovery trajectory now. In fact, we've seen Sydney housing values move to new record highs. So getting beyond the earlier record high, which was way back in the middle of 2017. I'll touch on that sort of trend in just a moment. So Sydney was a little bit of a latecomer to really lead these leagues tables again. Earlier, this was a story about markets like Perth and Darwin, which you should know have been some of the weakest markets, where they've been through a very sustained, long-running downturn. In fact, we're still seeing Perth housing values down about 15% from where they were back in 2014. If you buy into the Perth market at the moment, you're paying the same sort of money you would have been back in, say, 2006, to give you a bit of an idea of the value in that market. Whereas in Sydney, we've seen values recently return to the new record highs. If we start looking at some of the trends between houses and units, just a really broad categorization here, you can see most of this recovery trend in Sydney has been being driven by detached housing, which is kind of a new trend. Over previous growth cycles, we've generally seen houses and apartments broadly moving in parallel, moving at roughly the same level of capital gain, driven by a lot of investment demand in the unit sector, a lot of overseas migration, very strong rental conditions. Whereas during COVID, we've started to see some shifts in preferences. It seems a lot more people don't want to live in a high density environment. Maybe that's normal during a global pandemic. You want to be sharing amenity or in the same elevator with a bunch of other people and touching the same sort of things. I think that's pretty normal. But I think there's a little bit more to it than that. So if you think about Sydney, maybe even Melbourne is a better example, Melbourne then Sydney, there is still a bit of a supply overhang in these markets around the number of units that are being built. Specifically high-rise, high-density, what you might describe as investment-grade units. Across New South Wales, there's about 46,000 units that are still under construction, at least at the end of last year, that need to work their way through the pipeline at a time when investment activity isn't really all that strong at the moment. So my guess is when a lot of these apartments settle into the marketplace, they might have some challenges when they receive their valuation, could even be a little bit lower than the contract price. There might not be a large resale market for some of these inner city high density markets either, until we start to see tenancy demand getting a little bit better. And that won't happen until we see foreign students coming back and overseas or international borders opening up. So for detached houses, there's this, I guess, dual benefit of that underlying land value seems to be driving the scarcity value, driving the better rate of capital gain. But if you are looking in the unit market, I'd certainly wouldn't warn anybody away from buying an apartment. It seems to be the best apartment markets or best multi-unit dwelling markets at the moment tend to be the more owner-occupier style stock. Properties that aren't necessarily in the middle of the CBD, or Barangaroo is probably a good exception there. Properties that generally have larger floor areas, better fixtures, better amenities, generally a high quality developer behind them, that type of thing, seem to be going okay, as well as townhomes, villas, terraces, more that sort of medium density rather than really high density style of product, which seems to be a bit on the nose at the moment. You can see apartments still have some way to go before staging a technical recovery as well, whereas house values in Sydney are at record highs now, and they've increased by about 11% over the past 6 months. House values have. A lot of people like to annualize these numbers. That gives you a 22% annualized growth figure for Sydney house values, which probably won't be too far from the mark this year. I think when we see the full calendar year results, I wouldn't be surprised if overall Sydney values do rise by around about 20%. But we are seeing some early signs now that things might just be starting to slow down a little bit. Again, talking to our daily index, looking at the numbers this morning, as of yesterday, it's updated today in arrears, it does look like all the capital cities are just starting to lose a little bit of momentum, okay, which isn't surprising. We've seen housing values moving at the fastest rate since the late 1980s, based on our March data. So you wouldn't expect that really rapid, unsustainable pace of capital gains to persist for too long. And if I am right, and we are starting to see we're moving through that peak rate of growth, my guess is it'll be a fairly gradual tapering back to something more sustainable. It's still very positive, probably at least over the next 2 years, while interest rates remain as low as what they are. So what about some of the trends we're seeing across the sub-regions? I'll direct your attention to the graphs on the right. These are called SA4s, or statistical area 4s, right? It's just an easy way to break a market down into sub-regions to give you an idea of what's happening around the different precincts. So over the past 3 months, over the past 12 months, there are some markets that are performing better than others and some that are a little bit weaker than others or softer than others. We are seeing the strongest growth conditions generally around the outer fringes, particularly in the detached housing markets, Central Coast. Really good example. Okay, these are all part of the Sydney metro area. A lot of people think the Central Coast isn't part of Sydney. Technically it is. Okay, it's part of the greater capital city statistical area. So it is part of Sydney, but it is quite a long distance away. And that distance, that tyranny of distance, has been one of the factors that's probably held the Central Coast back from stronger rates of capital gain historically. It's generally been a relatively soft market, but I think now with more people able to work flexibly, there's remote working conditions, as well as just the sheer affordability of areas like Gosford and Wyong are really attracting more people into those markets. You could also make the same statement for some of the major metro, the major regional centres like Wollongong, Newcastle, those sort of markets. The Blue Mountains would be another one, which have also been exceptionally strong. So that is a good segue into some of the regional trends we're seeing. I won't delve into a lot of these markets just for the benefits of time, but you can see that through COVID, the regional markets hardly showed any decline at all. It was only a bit of a blip. Sure, they lost a bit of momentum, but the capital city markets did see a much weaker outcome through COVID. I think part of that was the fact when you look at the demographic factors that have contributed to that overperformance in the regional markets, there has been some demographic shifts. More people leaving the capital cities to move into the regional markets. But just as important as that is, there's been fewer people leaving the regional areas to come into the capital cities, which means that internal population growth in those regional markets has been much stronger. In fact, in Melbourne and in Sydney, we've really seen that trend being amplified, where a lot more people are staying put in the regional markets and a lot more people are leaving the metro areas to go to the regional markets, probably partly due to the remote working opportunities. If you're in sort of, the knowledge-based sectors of the economy, you can work remotely, then it's becoming much more common for people to do so. I know at CoreLogic, we've made that policy where for most of our staff, you can work remotely as much as you need to. And for a lot of the sort of businesses in the same sort of sector we're in, that's becoming almost a hygiene factor. If you want to recruit the best staff, you need to be offering up those flexible working arrangements where all you need is a computer, internet connection that's pretty decent and reliable, and a login to a secure server, and you can pretty much get your work done. In this day and age, it's pretty easy to monitor people's performance that way, and they can work quite autonomously. But we have seen Sydney just start to overtake the regional markets more recently. Whether this will persist, whether it's a structural change or not, is yet to be seen. But my guess is some of those major regional centres like Wollongong and Newcastle, the Blue Mountains, are going to be there as very strong performers for some time yet. They're much more affordable. They appeal to this newfound, preference for detached housing styles, for wider open spaces, for lifestyle benefits as well. Okay, as a regional, I live regionally as well in Queensland at the Sunshine Coast. We can see this happening, in real time. There's more and more people moving up there from Sydney and Melbourne and taking advantage of the lifestyle benefits, as well as the fact that commuting to, say, Sydney or Melbourne is pretty straightforward, let alone Brisbane. What about who's driving the trend? Again, really broadly, we've seen this different trend in who's actually fueling demand at the moment. This has very much been a recovery trend or a growth phase that's being fueled by owner-occupiers. Very different to previous growth cycles. So you remember back in, say, 2014, 2015 here in Sydney, investors were comprising nearly 60% of mortgage demand back then. That was one of the reasons that APRA waded into the marketplace in December 2014, and they introduced their 10% speed limit on investment credit growth. I don't know if you remember that. That had a pretty immediate dampening effect on the marketplace back then. And then in sort of March 2017, there was another round of credit tightening, which was a 30% speed limit on interest-only lending, which again pretty much quelled the marketplace. And then we saw the Royal Commission and credit tighten up even further. But this time around, it's very much owner-occupiers driving this recovery trend. And it's probably one of the reasons why the regulators and the policymakers like the RBA, the Reserve Bank, for APRA, they haven't been too concerned about the heat in the marketplace, because it is, I guess, a much healthier trend to see so many first home buyers and owner-occupiers buying into the market rather than investors. I think if we'd seen the same sort of trend but reversed, and it was investors driving this growth trend, we probably already would have seen some sort of credit intervention into the marketplace, as the regulators would have seen that as a financial stability risk. And that's the key thing they're looking out for. I've got a graph a bit later on whether or not we might see another round of credit intervention. It will be based on what's happening in credit flows, not what's happening in the housing market. A lot of people have suggested the RBA should be waiting in raising interest rates because the housing market's so hot. That's not part of their mandate. Their mandate is to keep unemployment as low as possible, to keep inflation in their 2 to 3% target range. APRA's mandate is to make sure prudent lending standards are being maintained. They're not going to intervene in the marketplace because housing prices are rising too quickly. It's just not part of what they do. So what about supply levels? And my favorite measure of supply is what you might describe as effective supply or advertised supply. You've got another element of supply, which is how many homes are being built. Going through a bit of a building boom at the moment as well, particularly for detached houses. But I think advertised supply has a much more important and immediate impact on the conditions in the marketplace. So this is what we're seeing in advertised supply at the moment. Just to describe the graphs, I know there's a lot of lines here, so it might be a little bit of graph shock here, so apologies for that. But just to explain it, the best way to read listings, because they're really seasonal, right, is to compare back in time with the same period, which is why these sort of graphs are really useful. So on the left-hand side, we've got the number of new listings being added to the market. I'm using a 4-week rolling count here. The really dark black trend line is the year to date, and the other colors are previous years. So it's really easy to compare back to the same point in time, which takes out a lot of that seasonality, which is really hard to remove just through a seasonal adjustment. So what we can see in Sydney is the number of new listings is now the highest it's been in at least 6 years. In fact, if I go back even further, it's the highest been since 2015 at the moment. So there's no real shortage of new stock coming on the marketplace. The important factor, though, is this graph on the right here, where you can see the black trend line is down the bottom of the graphs, which means total effective supply, the number of homes that are actually available for your purchase, is really low. Okay, it's way below average. In fact, it's about 12% below average. Now, you might be wondering, well, how can total listings be so low when we're seeing this absolute surge in fresh stock? It's because there's so many buyers out there. So we call this a really rapid rate of absorption. There's more buyers than stock being added to the market. So if you look at a ratio of, say, the number of sales to the number of new listings being added to the market, Sydney's tracking at around about 1.1, 1.2, which means for every new listing added to the market, there's 1.1 to 1.2 sales, which is why there's this downwards pressure on overall stock levels. And it's why, if you're active in the marketplace at the moment, you might be feeling a little bit of FOMO. Okay, there's this sense of urgency that people get when there's not much stock around, there's a lot of competition. And if you feel that if you want to really negotiate hard, or you want to take your time to really think, is this the right property for me? If you do that at the moment, somebody just comes in and buys that property out from under you. So people fear they're going to miss out. That's the FOMO thing. So at the moment, this is absolutely a seller's market. And we're starting to see more and more vendors tweaking to that, which is why we're seeing this new listings trend a lot stronger. Comparing back to last year is becoming completely irrelevant, by the way. Remember last year, we've basically seen the market stalling from both buyers and sellers' perspective during the lockdowns. You couldn't have an open home. You couldn't have an inspection of a property. You couldn't have an on-site auction either. So you can see that listing numbers fell much more sharply, that orange trend line there. So it is a seller's market at the moment. My guess is this will gradually start to change if I'm right, and we're starting to see things just cooling down a little bit from their frothy highs. We might start to see buyer numbers just easing off a little bit due to the stimulus winding out, due to less first home buyers in the market. Remember, first home buyers are really incentivized by the different stimulus measures that are out there, like first home buyers grants. Then you can couple that with a stamp duty concession if you're in Melbourne. You can add on your builders boost, so the home builder grant, which is no longer available. Add all those things together is why we saw first home buyers so active across the markets. And my guess is they'll be continuing to taper. We saw the first signs of that in February, and I think that will probably be something that continues and may take away a little bit from the level of demand in the market and start to see a bit of a gradual rebalancing between sellers and buyers in the marketplace. What about activity? This kind of highlights that point I was talking about. There's so much activity in the market. Again, it also gives a bit of a signpost for the preference shift towards houses rather than units. I'm just tracking the number of home sales here for houses and units. I'm using a 6-month trend. Again, that smooths out some of the noise and the volatility and the seasonality. You can see house sales are tracking about 15% above the decade average at the moment. Extremely strong. We haven't seen house sales this strong, as you can see, since the peak of the market over the last growth phase, whereas unit sales, well below average, nowhere near what they used to be back in 2015. And that's a symptom of the low levels of investment in this marketplace and probably some caution around buying into what have previously been the more popular unit markets around the inner cities, which are generally pretty weak now, especially from a rental perspective. Which takes me to rents. I'm really good at setting up segues for myself. So here's what's happening in rents, okay? And I thought it was really good to have some context here with the other capital cities because I've never seen rental markets this extreme in their divergence. At one end of the spectrum, you've got areas like Sydney and Melbourne where you can see house rents. Yeah, they're rising a little bit. They're up around 3%. Melbourne's up about 1%. So a little bit better than inflation for Sydney houses, but not much. Whereas in the apartment sector over here, you can see Sydney apartment rents down about 5%. Melbourne apartment rents are down about 8%. Remember, these are whole of city averages, right? So you have to understand there's a lot of extremes that make up these numbers. So if we look at some of the extremes around the market and look at the areas where rents have fallen the most over the past 12 months, probably no surprises here, right? These are your inner city high-rise precincts where there's been a lot of new supply added to these markets over the past decade or so. And that supply, particularly the supply overhang, has run headlong into a demand shock from less tenant demand due to closed borders and no international students showing up. So a lot of these areas have seen rents falling by, say, 15, 12, 13%. Not as bad as Melbourne, by the way. If I was to show a national graph here rather than just Sydney, you'd see that Melbourne's inner city, which has much greater dependence on foreign students and overseas migration than Sydney does for tenancy demand. We're seeing the Melbourne CBD is down about 25% for rents over the past year. Carlton's down about 20%. Dockland's down about the same amount. So Sydney maybe a little bit better. And we are starting to see some signs that these apartment rents are stabilizing. But I think it's going to be a long time before they actually start to experience any material growth, at least until we see international borders reopening. I think some of the reasons that we're seeing the stabilization in apartment rents in some of these inner city markets comes back to, office workers returning to work. We're seeing more hospitality workers back in. Restaurants, cafes are starting to hum a little bit better. But there's probably also this affordability discussion as well, where we have seen rents come down substantially in some of these areas which people like to live in, right? You want to be right in the CBD or in Surrey Hills or close to the uni, that type of thing. Rents have come down quite substantially, and that's probably going to start to vacuum more people into those markets where previously they might have thought it was a little bit expensive and they might be upgrading from, say, the middle or outer ring suburbs. What about the suburbs doing the best for rents? Absolutely the opposite. Okay, I didn't put a legend on this. It's pretty obvious. The sort of more greenish bars on here are houses. The darker bars are units. But the best rental performance tends to be around the outer fringes, particularly around the Central Coast, some of the Blue Mountains areas, your outer west, those sort of markets. There's a few exceptions there, but typically this really highlights this preference shift towards lower density, extra bedrooms so you can work from home if you really want to, have a separate study, that type of thing. And what about yields? Pretty important for investors. This has always been one of my, conundrums is most investors in Australia focus almost purely on capital gain. That's always the main game, fair enough, but they disregard yield. And I think yield is always going to be important. And you can see the yield profile in Sydney is now looking a little bit sick, right? It's down at record lows. Remember, these are gross yields. So you can see Sydney, record low, 2.7%, way down from where it was a year ago, which was already at record lows. maybe that's not too bad considering where mortgage rates are. You know, hopefully you're getting a mortgage rate that's got a 2 in front of it, maybe even a 1 in front of it if you're an owner-occupier, or you're chummy with the bank, or you're a really high-quality borrower who can negotiate really well. But still, generally on average, I think Sydney rents are going to be in negative cash flow territory. Whereas you look at most of the other cities around the country, typically yields are in that more mid 4% range for houses, getting up in the 5% range for apartments. On average, positive cash flow there. You don't need a negative gear. You're getting income as well as capital gain opportunities in a lot of these smaller capital cities that have stronger rental conditions and also don't have as high a buy-in price as well. So probably some better opportunities in some of the markets outside of Melbourne and Sydney at the moment. So I mentioned at the very beginning, there are absolutely some challenges, but there's also some good tailwinds. I won't go through all these factors, and at a glance, it may look like the headwinds, the challenges are outweighing the tailwinds. I don't think that's the case. I think we'll continue to see housing values rising, maybe just not as quickly as what we have been seeing over the past 6 months or so. But some of the challenges, of course, we're moving through right now. An exit of fiscal support, JobKeeper's finished. It's probably not going to be that big a deal. We might see unemployment blip just a little bit higher. We might see jobs growth stall for a couple of months, but there's plenty of momentum in the labour markets. If you saw the March data come through, this is what the labour markets look like for March. Absolutely a V-shaped recovery. A lot of people talk about a W-shaped or an S-shaped or a T-shaped recovery, whatever. This is a V-shaped recovery. It's obvious, right? It looks like a V. That's why they call it a V-shaped recovery. So absolutely, this is a V-shaped recovery. We're now seeing more jobs in Australia than there was pre-COVID. Absolutely stunning to see how fast the labour markets have recovered. Still seeing jobs growth even coming into the end of JobKeeper. My guess is that'll probably come down a little bit into the negatives for a couple of months, but that's not going to last very long. There's plenty of momentum in the economy, and we've consistently seen the economy outperforming forecasts. And you can see the unemployment rate is now below the decade average. The underemployment rate's below the decade average as well. Who would have thunk that, hey, about 12 months ago? And then there's the prospect of a credit intervention, right? This is probably the biggest risk in the housing market, and it's almost becoming a case of when, not if, okay? If you're reading the media, you'll hear people talking about, is there going to be another macroprudential intervention? Macroprudential is a big word. All it means is a new round of credit tightening from the credit regulator, which is APRA. APRA, remember, is the prudential regulator. They're mostly concerned about prudent lending standards. And these are the key things they'll be looking at. These are the key metrics. No longer are they too concerned about interest-only lending or the amount of investment in the marketplace. That's really low. What they'll be focusing on mostly is how many borrowers are taking out loans with a small deposit. That's your high LVR lending over here, which has ticked up a little bit. And how many loans are being taken out with high loan to income ratios or high debt to income ratios, which is here. And they generally have a little flags that go off if there's a lot more loans being written on 6 times or more debt to income ratios or loan to income ratios. And as you can see, the December data rose in both of those categories, as well as the higher LVR lending. Not enough to trigger any sort of response, but if that trend continues, it's almost guaranteed we'll probably see some sort of credit intervention that's going to be aimed at keeping a lid on household debt. The last thing the RBA wants is a really heavily indebted household sector. It's manageable while interest rates are this low, but eventually interest rates will get back up to their average levels. And if households are really heavily indebted, that simply means they're going to be diverting more of their incomes towards servicing their debt, not to spending. Okay, remember 60% of our economy here in Australia is people like you and me going out and buying stuff. It's consumption. So that has a real financial stability risk if we see household debt levels rising further than what they are at the moment. And the key sign is going to be any of these three ticking up higher. So watch out for those ones. That data is updated every quarter. The March update won't be out until June. So definitely a bit of time up our sleeves before APRA jumps into the marketplace. So I've used up way more time than I was given. Sorry, guys. Couldn't help myself. There's my disclaimer. You guys can soak that one up. And here's my details. I'm not sure if we're going to questions now, but yeah, good. Thanks very much, guys.
Thanks, Tim. That was absolutely amazing. And you can tell that you've got 20 years experience analysing markets. So thank you very much, Tim, for that presentation. You will notice a number in the left-hand corner of the screen. That itself is for questions later on. So we'll go through all the presentations. For those at home, if you've got a question, please feel free to text in your question as we go through. We won't go through them now, but at the end, we'll get the panelists up to answering those questions. And same for the audience here today. If you have any questions based on what Tim's talked through, what Vincent will go through in a minute and so forth, please feel free to text those as we go through. Good segue from Tim into Vincent. So we've talked a little bit about mortgages and so forth. So founder of Uno Online Mortgage Broking. Vincent's had a few wins and losses as he's gone through his last 20 years in the journey. And he also spent 20 years building software for mortgage brokers online and also banks. So no one better to speak through this than Vincent himself. So I'll welcome him onto the stage to talk through mortgages.
Need to work out how to use one of these things. So first for me, hi everyone. My name is Vincent Turner. I'm the founder of Uno. We've been going for about 5 years. We service nationally. We're essentially an online mortgage broker, and we deal with over 30 lenders. So fairly good knowledge of home loans in both the broking sense and the lending sense. My backstory, I guess, a little bit is I developed a bunch of software for banks and brokers, as we've said, but I've also had some pretty terrible mistakes buying investment property and some learnings that have come out of that. I'm not specifically going to talk about those tonight, but I guess there's a part of this story is with respect to home loans and the other part is with respect to the personal journey. Just with that point, just in terms of the journey you guys are on today, just by way of hands, who currently has an investment property? Who has more than one investment property for the moguls out there? Cool. Who has a property but it's not an investment property? Cool. It kind of is in a way, because obviously it's an investment, even if it's not an investment property. There's relevance here for everyone who's on every part of this journey, but I'm going to go into a few parts in the talk tonight. So I want to talk a little bit about the state of mortgages, and it was a great segue from Tim, both on the yield side and what's happening with interest rates at the moment. And I open with this kind of controversial point that yields are down to make the point that they're down in some places and not in others. And the point here is that you're never in a single speed market, and yields affect not only what makes an attractive property from an investment perspective, but it starts to have an impact on a home loan strategy as well. If you're thinking about going and looking at buying a property in Darwin, I think the number up there that Tim showed was 6.1% yield for houses. It's actually incredibly difficult to get a property and get approved for a property in Darwin compared to potentially in Sydney. They're harder loans to do. There's a lot of lenders that won't look at those markets, or they have challenges valuing in those markets. So what yields are doing actually can have a really significant impact. And we are seeing yields down, and we're seeing lenders not knowing how to deal with this. This is playing out really specifically in the case of buyers who are looking not to refinance, but to buy a new property, owner occupied or investment. Some banks won't even touch pre-approvals at the moment. They basically said, you know what, it's such a challenging market for the person who gets pre-approved to buy that we don't want to even look at them at the moment, and yields play a role in this. Rates are also in a really unusual situation. I think it's a fool's game to try and call the bottom of anything or the top of anything, but if I had to sort of make that call on the stage tonight, I would be saying that it's pretty hard for rates to get much lower than they are. The RBA has been relatively clear about where they think rates are going to stay and where they're potentially going to go from here. But even outside of the RBA has an influence on what the housing rates are, but they're not the only driver. A lot of the drivers are offshore markets and the securitization markets. And this is what enables banks who lend money to price their money at. So someone like Westpac, who has a deposit base, will largely be influenced by the RBA. In fact, during COVID, they even got given essentially buckets of money to lend, which is why you're seeing a lot of these really sharp fixed rates in the market. But what's happening in overseas markets is you're starting to see rates go back up again. You saw a massive shift in bond prices a few months ago. And this is important because what you're starting to see is, whilst there is very low rates at the moment, you're starting to see 4-year fixed rates and 5-year fixed rates actually start to go up. And this is a good indication that this isn't going to stay that low for that long. And you should factor that into your strategy about buying, but also about how you might structure your loan and whether you fix and how much you fix. And I'll talk about that in a minute. And as I talked before, approval times are getting ridiculous. And there's a couple of factors driving this. Some of it is the activity. You saw that one of those last charts where it's just off the charts in terms of the number of people trying to buy in the market. So that is having an impact. But there's other things that you wouldn't think of. Most of the major banks offshore a bunch of their processing. when they offshore their processing, they were not able to operate during COVID, and they had to bring a lot of that back onshore. And a lot of them are still working that out. Now, throw that into the mix with a low yield and low interest rate environment, the banks are still hammering to try and get business. So they're offering these massive cashbacks. I'm assuming you guys will have seen some of those in the market. So they're actually creating a problem for themselves. They're getting a huge amount of demand, and without the teams that they can scale offshore to be able to service it. This is a massive factor for you if you're thinking of buying an investment property. Will a bank even give you a pre-approval? Are you dealing with a bank who will do that? And how long will it take to get an approval? We're seeing banks take 3 to 4 to even 6 weeks to do what is a fairly standard pre-approval. It's not all banks, but it's certainly a reasonable chunk of them. Cool. So some of the key takeouts from those 3 macros, it's all massively subjective and specific to your situation. It's hard to do generalizations in lending because obviously a single lending decision is made on the security you're interested in, the income that you have and what you want to do with the property. But there is absolutely a shift, and we saw this quite pronounced pre-COVID. There was a bit of a pullback, a shift to non-major lenders. We're seeing a lot more people go with majors just because they're so strong on the price perspective. But if you have a property investment purchase that you're looking to make, considering lenders that you may not have heard of is absolutely advantageous. There's some advantages in working with a broker in doing that. As I said, we are an online broker, but there's actually banks out there and lenders out there now who just don't deal with brokers. And it would be remiss of me not to say you should also be at least exploring these options and understanding some of the lenders who are coming to market who you just can't get via a broker. The challenge you'll typically face is that most of those lenders have fairly vanilla approval, is in that they can do easy loans, something where you're PAYG and it's under 80% and it's fairly straightforward security. But if it's anything more complex than that, a lot of the non-brokered based lenders, typically online lenders, they just don't have the depth of policy. So a broker can help. The other thing that's happening, which is driven by the trend in properties, is a lot of people probably don't realise this, but property prices and the LVR inherent in your loan amount drive the actual value, the interest rate that you have to pay. And it used to be pretty simple. It used to be like, okay, well, it's under 80% or over 80%. If it's over 80, you pay LMI and it's a higher rate. You're getting lenders now who have 5 or 6 graduations of that. If it's 90%, there's a rate. If it's 80 to 90, there's a rate. 70 to 80, and even below 60, there's a lender we're aware of that has a different rate if you're under 30% LVR, and it's significantly different. It's like 40 basis points cheaper. And so you have this situation where if you've got a property, you've held onto it for a while, and you're sitting there and you perhaps have a loan, you may not, the bank's never going to tell you. Most banks, one bank will, most banks won't. So you may actually be sitting on a rate that you're paying way too much just because you've kicked into a new LVR band. And I kind of think of it as a free renovation. You know, you can essentially go in, get a cheaper rate, get 30 grand out to do a kitchen, and you'd be paying the same amount, pay the loan off the same amount, pay the same amount of interest, and have added value to your property. So there's strategies you can think about like that, using LVR as a way to kick up. Cool. All right, just a couple of common myths. Just mindful of time here. How are we going? Good? Okay, great. Normally I talk too fast, but maybe I am talking too fast. Cool. So I want to talk about interest only, because this is something that is kind of interesting. I think when government gets involved, they generally have the best of intents, but often they can create a distortion in the market. Stamp duty is probably the obvious example. But in interest only, we absolutely saw some macro prudential changes that meant that banks started to be told you're not allowed to do as much investment lending, and that worked. Then they were told you're not allowed to do as much interest only lending. And so the only way a bank knew how to restrict the amount of interest only lending was to just make it more expensive. And about 3 or 4 years ago, the delta between interest only and P&I for investors was about 60 to 70 basis points, which is a huge amount. Now, the kind of common myth that everyone has as an investor is just make it interest only. Why would you pay off the loan? There's no tax benefit in paying off the loan. I was like, this just doesn't make sense, but let's run the numbers on this, which is kind of my golden rule in all of this. And we actually looked at some scenarios and found that with the tax benefit taken into account, with the yield on the property taken into account, and with the differential in rates, we had one customer who we saved about $70,000 over 5 years simply by putting them on a P&I versus an interest only in their investment scenario, because the tax benefits were nowhere near as much as how much extra interest they were paying. So it's a really common myth. It's less pronounced now because the delta between P&I and interest only for an investor is about 30 to 40 basis points, not 70. But it is still the case. And banks seem to have just gone, you know what, we can make more money out of investors, so let's just charge them more. And, you know, we're doing our job for APRA, but in fact, they've worked out how to increase the yields. It's not the case for all lenders. I found a lender the other day that had a 2.49% interest only for an investor, which is incredibly low compared to what other, like the major banks are well into the threes. So it does depend on the lender, and makes the point. But if you are going to go interest only, make sure you're doing it for the right reason. Fixed and variable is another one that I think we see a lot of, and this isn't just with investors, it's with owner occupiers. Traditionally, people think of a fixed as kind of a hedge my bets, right? And really, if you think about fixed rates, you're typically betting against the bank, and the bank is the house, right? And if you're going to get fixed, the normal rule of thumb here is that if you're fixing, you're doing it because you want certainty. That's the number one reason you should be fixing, because it's hard to beat the bank. It's a bit weird at the moment because fixed rates are so low and variable rates from the RBA at 25 basis points. It's kind of hard to see fixed rates going much lower and see variable rates going too much lower. Now, people said that 2 years ago, 3 years ago, and fixed at 3.5%. I count myself in that, so I made that mistake. But there's only one country in the world that went to negative interest rates. I think it was Denmark from memory. Someone correct me if I'm wrong. And so, was it Denmark? Japan, thank you. I think I meant in terms of pure housing lending rates, but I think it was Denmark. But I'm happy to be wrong. Anyway, the common logic here is if you're going to fix and variable, you should do half fixed, half variable. And that just doesn't apply. If what you should be doing is working out why would you fix and why would you do variable, and what's the economic driver for doing this. Typically, if you're fixing, you can't pay off the loan faster. You're limited to paying off $10,000 or $15,000. But if interest rates are at 2%, why would you pay it off faster anyway? You would put that money into anything and get more than a 2% yield. So the idea that you can't fix 100% of your loan for an investment property is not necessarily the right outcome if you can put extra money that you have into something other than paying off the loan faster. And if fixed rates are at 1.79, call it low twos for an investor loan, it's really hard to work out how that's going to get much cheaper. So the fixed variable myth is just don't go half fixed, half variable. And the third and related point is that just fixing limits you. The only worry you should have with fixed, obviously, realistically, is if you're going to sell the property, make sure it doesn't limit you from selling the property, or that you understand the break costs involved with that. Break costs are kind of a dark magic, and the banks don't actually publish how they work them out. But essentially, they worked out on economic loss. It's if you had stayed with the loan, then we would have made money. And if you leave the loan, we want the money we would have got. So you understanding that cost if you have to sell would be the reason you might avoid fixed. Otherwise, it's not necessarily a bad option. All right, cool. Key takeouts. Going back to the number one rule, run the numbers. I talked a bit before about a failed property investment. I essentially bought a unit in Kiril. I never saw it. I never went to it. I had no idea. I didn't run the numbers. It looked nice in the ad, and it was near a beach that I liked, which is literally the worst reason to buy a property. I bought it for 280. I sold it for 240, and I lost money on it every single year. Like, it was negatively geared, and it didn't have any capital gain. And it was 100% because I didn't run the numbers, and the numbers were relatively straightforward. Now, there's obviously the numbers that you run with respect to the property investment itself, but running the numbers with the mortgage is the same. Comparison rates are incredibly misleading. I wouldn't go anywhere near them. Someone telling you how much money they can save you over 30 years or 25 years is incredibly misleading. It doesn't help. Someone telling you they can save you $107 a month also doesn't help. You need to have a sense of what's this going to cost to move from the loan I have to the loan I want to get to within, say, 3 years, to truly understand whether it makes sense to move mortgages or not. I'll show you a tool that we have that helps you do that just after this. And to make that point, when it comes down to it, as an investor, you kind of get to be dispassionate. Is this a good economic decision or not? If you're living in the house, it's still good to make good economic decisions, but maybe you're swayed by where you want to live and whether you want to put paint on the walls. Okay, so last slide. In terms of some of the optics, question the myths. That's the number one thing. That's the easiest thing to do. Those are the three that I pointed out tonight, but there's going to be other myths. If you hear a common truth, which it's always better to do X, just run the numbers on that and work out whether that's true. Most of the myths are relevant to a particular context in terms of what the market looks like, and the market's changing all the time. Rates are literally changing daily, and as is the market generally. Run the numbers, as I said before, literally the number one rule. And I think the last thing is, obviously, if you're making an investment decision, it's good to work with people who can provide expertise in relevant areas. So whether it's a broker who's helping you with the loan, or property management, or a buyer's agent who's helping you to find a place, work out where your gaps are and put a team around you, and make sure they're coordinated on the strategy that you have, so that they're coordinated rather than stepping on each other's toes. All right, just a little plug for a tool that's available to all you guys. Loan Score, we're committed to helping people get a good loan, but also stay in a good loan. That actually means if you wanted to do that yourself, you'd have to basically go to comparison sites every single day and run the numbers. Loan Score is a free tool that basically lets you put in the loan you have at the moment, and it continuously monitors it. Every day it runs your loan scenario against the 30 banks we have. It runs all the analysis of if you change from your bank to any of these banks, how much money would you save, including the LMI fees, the switching cost, the upfront application fees, and the ongoing fees. It doesn't include the break fees because we just can't calculate them. And it gives you a monthly update, tells you whether your loan's any good or not. And if it's no good, then you know what to do. It also tells you how much you could save from your current bank, which I think is important. So monitoring your loan and staying on top of your loan, great tool, completely free, and it sends you alerts. All right, last little roundup, run the numbers, get good help. Whoops, sorry, I wanted to go back. Staying on top of it, just being mindful of whether if the market's moved, you're still in the right place. And remembering the golden rule, which is the guy who has the gold makes the rules. The banks tend to own the game in terms of where interest rates and everything else is going, but for the macro, and they decide if they want to change it. And so you have to be conscious of that nature in the market. Cool. If you want to get in touch, email me, or you can go and use Loan Score straight away. Thanks a lot, guys. Appreciate it.
Some really key insights, Vincent. Really, really good. Next person, Kiril. I was lucky enough to be in Melbourne 2 years ago, and Kiril spoke there. I was really, really, really impressed with the way that he goes about his presentations, the way he goes about talking to an audience. So he has a big rap sheet. Bachelor in business, has been a financial advisor for the last 27 years. Started his own business 18 years ago. He's a licensed real estate agent, valuer, and auctioneer. So before further ado, the guy who will probably wow you significantly, Kiril.
Thank you, Paul. Good evening. No pressure. We have 10 minutes, or I have 10 minutes, so it feels a little bit like speed dating with property. So I'll try and stay on. Do you have the clicker? Someone stole my clicker. Oh, here it is. Okay. Ta-da. Okay. All right. Thank you, guys. A little bit about us, Strategic Investor Group. We are a financial advisory firm. We are located here in town in number 1 O'Connell Street, and we specialize in giving financial advice. Now, for those of you that might have seen a financial advisor in the past or have a relationship with a financial advisor, you're probably well aware that a financial advisor will typically try to sell you managed funds or shares or talk to you about insurances. And when I sat down with a number of financial advisors, having been one for a long time, I would say, out of interest, how did you make your money? And almost all of them would reflect on their first property purchase and how I paid this, small amount of money for this property, which has gone up 10 times. So here's an industry which prides itself on giving advice on managed funds and shares, and yet themselves don't eat their own cooking. So we started the business about 18 years ago with advice as the principal, but focusing on property and helping clients make good property decisions. We then created a lending arm because we felt that the clients were going out and talking to their banks, and their bank or their broker was stuffing up the loan and not structuring it correctly. And then the last part of the puzzle is our buyer's agency business. So we specialize in helping clients actually buy and negotiate and find the right property here in Sydney only. So that's just a little bit about us. But I'm going to talk to you predominantly about the advice side of the business today. So this is my disclaimer. I could either give you all 2 minutes to read it, or I could say, don't listen to anything that I say, and please don't take my advice. This advice is general in nature and not specific to your own personal situation. Okay, so this slide actually talks about what we do, which is the advice process. And what we say here is that not all advice strategies are created equal. In fact, what we found is the devil is in the detail, and most people miss that. So I liken it to sort of sitting down with your architect before you build. So imagine that you own a block of land and you wanted to build a 3-bedroom house on it, and you arrived at that block of land with your builder and you told your builder, this is what I want to build. And most builders would be able to build it for you. However, if you wanted to maximize the way that the building, the orientation, how it faces the sun, making sure that the floor plan is right, making sure that your floor space ratio is maximized and that you get the best outcome, you need to plan for it. So you sit down with your architect and you plan for it. And that's effectively what we do. So what we do is we sit down with clients and we help them, first of all, make sure that their strategy is correct and that they're putting together their property portfolio in the right way. And what I'm going to do is go through a couple of case studies right now and hopefully show you some of the tips and some of the tricks that people trip over. Okay, so I might start with a question. And a conversation around property wouldn't be right without an auction, so I might even auction off the answer. How many Australians own an investment property? This is for you guys. Anyone? Oh, God. Damn, you're very good. Anyone else? 2.6 million? I've got 2.6 million, 2.6 million going once, 2.6 million going twice. Do I have any rises? Come on, guys. More or less? Oh, okay, I'm going to give you the answer. Close. Close. Considering that there are 25 million people in this country, 8% of the population owns an investment property. Australians love property. Okay, of those people that own a property, what percentage do we think only owns one? No, you're not allowed to answer. Anyone? Anyone? 80%. Very good. 75% of those people that own an investment property only own one. What about two? 8? 19. 19% only own two. 3? Oh, close. 5. And then I won't necessarily go through each one, but what you'll see, and before I let the engineer or the sorry, yeah, they are a year old. Yeah, okay. Tough crowd. Tough crowd. Before the engineers or the accountants in the room add up all those numbers and tell me that it doesn't quite add up to 100, which I know, it's 99 point something. The point of this slide is this, that most people, most investors buy their first investment property because they've been told buy an investment property and they stop. And the problem with that as a strategy is that if you plan to retire on a property portfolio, when we sit down with clients, we say, what's your number one goal? And they say, well, I'd like to replace my need to work with a property portfolio. You're not going to do it with one property. And yet most people stop at one property. All right, so let's look at the size of the prize. And again, these numbers are a year old. The size of the prize, commercial real estate in this country is about $1 trillion. The value of the Australian listed ASX is $1.8 trillion. Superannuation industry is a little bit higher now than 2.3. But the residential property market is $7.1 trillion. So by far is the greatest asset class in this country, and it's the largest investment for most people. So these are my 3 case studies. As I said, I'm going to go through quickly and hopefully you'll get some value and you might find something in one of them that applies to you. So case study number 1 is the accumulator. And we see these people all the time. They come into our office and they say, I have X amount of money surplus after I've done a budget. And in this case, this client's name is Nick. Yes, it's his real name. He's come into our office and he said, I want to pay off my home loan, but I want to put aside about $100 a week to other investments. Can you show me what it will mean if I put money into my home loan, or if I put money into my superannuation, or if I do something else with it? Okay. So in this situation, that something else was buying an investment property. And for Nick, we bought this property in just close to Balmain, Terry Street. For those of you living in Sydney, you probably know where it is. The property was a couple of years old when we bought it. It's a 1-bedroom, and I'll walk you through the cash flow. What you need to know here, there's a lot of numbers on the screen, but at the end of the day, the rental comes in, the cost of running the investment property goes out, you get some tax benefits, and at the end of the day, what did this property, holding this property cost Nick? It cost him $96 a week out of his pocket after all was said and done. So that's about $5,000 a year, and he wanted to put aside $5,000 a year into something. So what was interesting is this: the purchase price was $905, the rental $690. So the rental yield now is that. And look, the yields have fallen, as Tim pointed out in his presentation. But the interesting slide, or the interesting part of the slide that I really like and the clients love, is this one here, this pie chart here. Who's paying for the cost of holding this property? And interestingly enough, you can see the tenant is paying for 68% of the cost of holding the property. The balance of holding this property is paid for between the tax office, the ATO, which pays 22%, and our client only pays the 10% difference out of his pocket. So he can hold an almost $1 million investment, but it costs him about $100 a week. Now, we fast forward 10 years, and we want to show him what will his actual total return be over that 10-year period. And we want to compare it to the other two options that he had, which was put money into superannuation or pay off his home loan. So you can see how it compounds over 10 years. And at the end of 10 years, sorry for those of you sitting here, you might not be able to see this part of the slide. At the end of 10 years, we wanted to compare the net result for Nick. And what it shows you here is that the net result for Nick is that if he puts money every year, $100 a week into his home loan, at the end of 10 years, he's going to pay off a whopping $65,000 of his home loan. So back when we can fly again, that's really not going to necessarily pay for much more than a holiday for Nick and his family. If he puts the money into superannuation, you can see that it does do slightly better. So what we did is we grossed up the contribution for contributions tax, and then we put the money into superannuation, and we assume that the super fund can get a 5% return year in, year out consistently every year for 10 years. And you can see that he actually does better by getting $106,000 as a result in his super fund. And the surprise winner is property. This property, if it grows every year by just 5% a year, capital appreciation, 5% year in, year out, not the 15 or 20% that we're experiencing at the moment. But we said long-term, and we sit down with clients, if you can expect a 5% return a year per annum, year in, year out, this is what you can expect. At the end of 10 years, we sell the property, we pay back the bank, the balance of the money that we owed, we pay capital gains tax on the gains, and at the end of it, he comes out with $381,000. So that's just over 6 times the difference of what would have happened if he just put that money into his home loan and paid it off. Case study number 2 is the upsizer. We see this all the time. This is the most common situation we see. We see husband and wife or partner or individual that has bought a property, possibly their first property. And what they've done, they've lived in it, and maybe let's say, I just put some numbers around it. They bought a unit in Bondi, just as an example, for $500,000 10 years ago. They got pregnant, they had a baby, they started a family. That property has grown in value. And after 10 years, they've paid off most of that value of that unit. And then they've said, now it's time for us to buy our dream home. And they want to buy, let's call it a semi in Bondi. I'm just using Bondi as an example, but it can apply anywhere. So the value of the apartment that they had, they paid $500,000 for. It's doubled in value and it's worth $1 million now. They go to their banker and they say, we found our dream home. It's $2 million. Can we please borrow the $2 million against the value of our unit? Because we don't want to sell the unit. We want to be property investors. When we look at the cash flow, which means sitting down and looking at what it will cost you to do this, we look at the situation and we say to the client, you have your debt structured the wrong way around. And they say, well, what does that mean? What does that mean? It means that what used to be your home is now your investment property, and you're going to have no debt on it. And the home, which you're going to have where you can't claim a tax deduction, is going to be 100% geared. So you're going to have your debt structured the wrong way around. The problem with this is that when you collect your $1,000 a week in rent for that apartment, you're losing half of it to the tax man every week. So at the end of the year, you've given away a considerable amount of money, about $25,000 to the tax man. And in my first slide, you could see for that, you could buy 5 investment properties if you could get the funding. So what the client could do is, instead of owning and holding both properties, you could do what feels like taking one step backwards because you're actually selling your property, but then you're doing that in order to take 3 or 4 steps forward. Because by doing that, you're selling the property, the apartment, you're then paying off half the loan on the new purchase, which will be your home, and then you're using the equity in that to go and buy a number of investments. So in the first example, you only end up with 2 properties. And in the bottom example, you end up with your new home plus 3 investment properties, which is 4 properties for the same cash flow or same net cost to the client. And I went through that pretty quickly, but I can answer some questions afterwards. And the final example I've got is the downsizer. And the downsizer is something that we feel is an important conversation to have with clients about 10 to 15 years before they retire, because of the value of how much money you can make a downsizer. In this example, we've got husband and wife that own their home in Mossman worth $5 million. And they know that when they retire in 10 to 15 years' time, their property will double, hopefully. And what they will do is they will sell their Mossman property for hopefully $10 million. And then what they'll do is they'll buy their downsizer apartment where they hope to see out the rest of their years in Balmoral, as an example. And they're going to spend $5 million, and then they'll give $5 million to their financial planner to manage. What they could do is buy the downsizer property in Balmoral today for today's prices. And so what they do is they take a loan against their home in Mossman, and they buy it. Instead of at $5 million, they pay $2.5 million buying the Balmoral unit at today's prices. Then we wait 10 to 15 years. Hopefully both properties have now doubled in value. They then sell the Mossman property, as they did in the first instance, for $10 million. They pay off the loan on Balmoral, and they end up with an extra $2.5 million in the kitty in retirement, which over a 10-year period, they've just made an extra $250,000 a year, year in, year out, tax-free for 10 years, which I think is pretty smart. All right, I think that gives you a bit of a sense of what we do, and that the devil is in the detail, and planning, just like when you're building your own house, is really important when it comes to your finances and buying property. Thanks.
Very sharp, as per usual. Our last presenter is Ash Frenken. So he's the CEO and founder of Proper Property Management. It's founded in 2017 and have since raised over $7 million over that period of time, and one of the fastest growing property management businesses in the country. So without further ado, introduce Ash Frenken.
This little bad boy. Cool. Good evening, guys. Thank you for coming. For those of you who don't know who Proper is and you found the event on Facebook or through an email, Proper is a tech-enabled property management play. We have been running for about 4 years. And one of the things that I really quickly learned by stepping into this business is that investing in property is so much more than property management. It's actually really complicated. And, you know, in property investors like myself, when I first started, and the reason that I got into this whole thing was because I've had some pretty crappy experiences with property managers, both as a tenant and as an owner. And I realized quickly that actually there's a whole lot of other people out there just like me that, you know, need help and need guidance around all things property. And property management is just sort of one pillar in that. I'm not going to speak to you guys about too many statistics and numbers tonight. The conversation coming from me is really through the eyes of the customer. And, you know, the conversation tonight to this point has been what's going on with property values, what's going on with rental values, how do you structure a loan, how do you structure your investments so that you can grow your portfolio. And there's been one really important person missing from this conversation. Who do you think that might be? Who's paying the mortgage? Like the tenant, right? So the tenant's missing from this conversation. So we're going to talk a little bit about the tenant and how maybe you should think about what they're going through in this current moment and how that might influence how you look at your property now, and also how do you future-proof your property moving forward as we've come through this really difficult time, which is COVID-19. So it's no surprise, and we've all it's all been covered off a lot tonight that Sydney rents are down. They're on the mend, but we're still a long way from normal. And I think it was Tim earlier in the night had said that we've got a fair while to go before things come back up to where we expected them to be. The year-on-year change for property for rents. You're seeing a negative of 6.5, and for houses it's at 0.9, and that really goes to what sort of Tim was talking about higher density areas taking the brunt of the hit. In terms of vacancy rate, I saw a lot of hands go up earlier in the night around who has an investment property, who's experienced their tenant leave and you've had to put the property back on the market for lease. Hands up, cool. Keep your hands up if your property was on the market for a really long time or more time than you expected. Yeah, cool, awesome. That's certainly what we're seeing happen across Sydney. There are parts of Sydney now that are maybe not, starting to recover faster than others, but we're still certainly seeing the time to lease still quite a long period of time. In fact, the market average is sitting at around 29 days across Sydney. For proper, at the moment, it's sitting around 22 days, which is around 20% up on where we had seen at the same time last year, or just pre-COVID rather. So what's driving these metrics? We have an increase in housing supply. So, Tim's kind of spoke to it earlier, but we've got a whole bunch of short-term rental stock coming on the market because we've got closed international borders. So there's a fairly significant chunk of the rental market, it's just over sort of 5% that was put aside for short-term stay. So that's your Airbnb stock. With international borders closed and for much of last year, state borders closed, a lot of that stock was pushed into the long-term residential market. So we had this huge surge of supply. We've had negative population growth, particularly in Sydney, that actually depends on a lot of interstate migration as well from other states, but also, international migration and overseas students are pretty much non-existent at the moment. And so we're also seeing a reduction in demand. Unemployment or underemployment, I think, as Scott Morrison likes to talk about it, is a big factor still. So particularly with JobKeeper finishing at the end of March, we're still seeing some people under rental stress, and there are still absolutely across our portfolio lots of rental distress arrangements in place as well. And finally, a movement to work from home. So no longer are people sort of bound to locations because it's close to their office or their working environment. We're seeing, people retreat to the northern beaches or the Central Coast areas where you're seeing a lot of those, improved rental figures from the last quarter. So a big consideration factor is post-COVID, and with all of these kind of factors in play, your tenants' needs from your property are starting to change. And if you're a smart investor, you're going to want to start to meet those needs, right? Meet the needs of your customer. That's what anybody should be doing. This is the working from home statistics. So what we saw in both metro and regional, metro on the left and regional on the right, pre-COVID is the dark blue. 22% of people are working from home. Post-COVID, in metro regions, 75% of people are working from home. The number is also not as strong in regional, but it's still pretty good. And the latest research basically says that 75% of people believe that their employer will continue to allow them to work from home at least 2 days a week in perpetuity. That is something that will never change. It's certainly, I don't know about you guys, who's working from home in the room now? Yeah, cool. Our entire team at Proper are work from home. We have an office and they come into it on occasion, but everyone's working from home and we're in real estate. This, of course, puts an added pressure on how suitable is that property for that style of an arrangement. So what behavioural change have we seen post-COVID-19 in tenants? We are seeing a huge increase in the number of people that want to inspect property digitally and actually not turn out for an inspection at all. How your property is presented online and the way in which you get in front of people online now is more important than it was even a year ago. And, we've seen all of the articles for, from realestate.com.au around how, the movement is further online, but now with things like 3D virtual tours and real estate agents, creating videos for people to inspect without actually ever touching the property, we're still seeing more than 10% of our applications approved without a physical inspection. So how your property is positioned online and kind of what digital marketing assets it gets will determine how successful it is. I want to negotiate the rent or the lease arrangements. Has anybody in here had a tenant try and negotiate their lease conditions? Yeah, cool. We spent pretty much the better part of 12 months negotiating with tenants on lease conditions, but it's becoming less and less common in the last couple of months as we're starting to see the recovery in the market, but super common where people would start to offer unders or ask for additional like provisions to be made in place of the lease to make the property more suitable for themselves. And that's something you want to kind of like get really comfortable with, that that's going to still be around for a little while. I want or need to modify the premises to make the property suitable for my situation. And you know, there's been a bit of industry reform in March 2020. We saw the largest residential tenancy reforms come in over 10 years, which provisioned the allowance for tenants to make minor renovations or modifications to a property without your approval. We're starting to see more and more requests come through from tenants to change floorboards, you know, install study desks, you know, really start to modify the property as they start to think about how it meets their needs, not only now, but into the long term, particularly as they're working from home. So start to think about that and what your response might be if you got that from your tenant. And finally, I expect more from my real estate agent. As people have moved to work from home, so have their hours have become so much more flexible. And I'm not sure about those of you that have said you're working from home, but I know I work from home and I kind of get up early and I'll do stuff and then I'll go out for like a walk or a run and then I'll come home and I'll do stuff and then I'll get back on the laptop after dinner and do stuff. And we've become a whole lot more flexible with our working hours. And that's kind of also changing what our expectations are of service providers like real estate agents. And people are starting to see the need for these kinds of service providers to be available for longer periods of time. And that's what we've definitely seen across our agency as well. So what are some of the considerations for smart property investors into 2021? So invest in your property, and now is a great time to do it. Vacancy is going to cost you a whole lot more than maybe some minor property upgrades or improvements, and you will obviously get the upside on the capital improvement in the long term. So start to think about how those needs of tenants have shifted, i.e. need for work from home spaces, maybe the property is a little bit dated and there's a lot of other competitive stock on the market, particularly as in 2020, we saw a huge flood of new development stock come into Sydney as well. Think about now being the time where you might want to start to spend, because a vacancy cost is just dead money. You may as well pump that into your property and reap the capital improvement. Be flexible and keep good tenants. If you have tenants in your property at the moment and your lease term is coming up for renewal, start to think about, how is that property priced in market, and should I be passing on a rent decrease just to keep them in? If you're looking at a 29-day vacancy, that's a month of lost rent. Start to really think about how that might influence your returns over the next 12-month period. We're still 12 months plus away from getting back to improved conditions. We need overseas students to return. We need international borders to open for that to happen. So if you've got a good tenant in your property now, maybe consider a $10 or a $20 a week reduction to have them re-sign and gain that level of certainty over the next 12 months. Understand your risks and exposure. Who is across all of the compliance detail for the New South Wales tenancy reforms that came in March 2020? Yeah, you might be. No, you're not? Okay, cool. You probably don't need to be, but you need to know that your agent has you. A lot of people in this room will probably think that, oh, well, that's on my agent's head. It's actually kind of not. It's actually on yours, and you're effectively entrusting your agent to manage all of your risk. Get across some of the detail and start asking the right questions of your agent, because risk exposure is a big one. And for New South Wales landlords, the exposure is significantly increased post those reforms. We've just gone through some major reforms in Victoria, which I expect will be on their way for New South Wales at some point in the near future as well. And review your agent's fees and service offering. Now's the time to have that conversation. So often do we see people that are coming to us with, grandfathered fee structures in the 7% range, which are just so far above where you should be paying, but also not really getting much from their agent in return for that. What's on offer now out there in the marketplace is pretty competitive. And if you aren't reviewing what your agent's offering you and they aren't helping you reduce your risk exposure and keep your good tenants, and they've made a mistake, that's no longer acceptable. So now is a good time to start reviewing. And for those of you that don't know, you can switch your agent at any time. You don't lose your tenant. You're not bound to that agent for any period. In fact, most investors stay with their real estate agent for a period of 9 years, and generally are quite unhappy with their real estate agent. In fact, the net promoter score for property management is -6, which kind of pegs it next to Telstra. So for everybody in this room, on average, they're about as happy with their property manager as people are with Telstra. And that's a pretty crappy statement. So it's time to make a change. Just happens to be the one that I picked. How do we sort of see the future changing for investors when it comes to the management of your investment? The first thing, if I haven't already alluded to it enough, it's more significant industry and regulatory reform coming through. In Victoria recently, we've just seen every single investment property in Victoria now needs a twice yearly gas and electrical safety check at a cost of about $1,000. And that needs to happen every 2 years. We're probably likely to see that come into New South Wales at some point in the near future. There's probably going to be more reforms that mean that you have to meet more tougher compliance requirements. So get across the ones that are in place today, and be ready for that in the future, and make sure that you're geared up with good advice and recommendation and a team behind you that's prepared to support you, which should be your property manager. We're also likely to see these like suppressed rental conditions continue for at least the next 12 to 18 months. It was really common through COVID, and I don't know if any of you got this advice, but I'm also a tenant too. And it was really common to see real estate agents or property managers recommending to landlords, just do a 6-month lease. Things are going to get better. Just do a 6-month lease. Things are going to get better. Things are not going to get a hell of a lot better in 6 months, and don't put that level of exposure on your head again in such a short period of time. Buckle down for the long haul. We're here for 18 to 24 months. There's a whole lot of stuff that has to go right in order for things to really improve for us. So think about how you're prepared to handle the next 12 to 18 months with all of those sorts of different expectations of tenants, and obviously all the economic conditions that are kind of circulating as well. And finally, how are we thinking about future-proofing, our customers or our investors, in fact, that are with Proper? I guess one of the things that I've learned over the 4 years that I've run this business is that the everyday mum and dad property investor isn't super cashed up. You're not sitting on traditionally a crap load of cash, and when things go wrong, it kind of hurts. When a hot water system breaks down and it's $2,000 on a Sunday, that really eats into your returns, and that's not something that you want to be doing on a regular basis. Things like variables in vacancy rates across the city, and obviously a pandemic, not a lot of people can predict, but we're starting to see people start to quite fear vacancy. And we've started to think about this problem and think about how we can perhaps better service our customers in the long term. So we're looking at how do we reduce the variability of owning investment property by introducing a product that helps you guarantee your returns. So late last year, we actually were invested by one of the largest insurers in Australia, and we're starting to look at products that both help you reduce risk when it comes to maintenance and repairs, and reduce and remove risk with tenant variability, vacancy, and tenant delinquency as well. And those will be the products that we start to roll out over the course of the next 12 months. And I think what we're hearing from our customers is those are the products that people are looking for. You might be happy to pay a slightly higher management fee to know that when your tenant moves out, you're still going to get paid your rent. Or when your hot water system breaks down, your property manager is going to pay for it for you. And that's sort of the direction of where we see this industry going. And actually the older school, traditional mum and dad property managers managing small rent rolls of 1 to 200 properties will start to consolidate, and we'll start to see this move towards more certainty type management products. So that's something else that I consider you to start thinking about, and what you're more likely to see roll out, as we have seen it done in the US over the last 2 to 3 years quite successfully. Cool. That's me, guys. I hope you've enjoyed the evening. I think we're going to throw to Paul for some questions from the panelists. If you haven't already texted in, it's okay. We're going to have a couple of guys running around with microphones. So Kiril, Vincent, Tim, if you would like to join me on stage, and perhaps we'll just see if there's some any questions. And do you have the text number that you can put back up on the screen, just for the guys at home on the webinar? Cool.
Okay. First of all, thank you for all four of the gentlemen for speaking about their individual areas of expertise. We'll give them a round of applause for everything they've just talked through. I want to start with a serious question. And when I say that, you know, I have a bit of tongue in cheek. I did say it before. It's gone, but I know what the question was. Kiril, you're so handsome. Can you please ask him about his skincare routine?
Dove.
I hope people are writing that down. Okay, serious question. For proper, I'm an advisor with clients that we do everything we can for them to get the best property they can, from structure, strategy, finance, and the actual purchase, only to have something agent not do what they should do. I transferred all my clients to your service. Could you provide us with an overview of our client's portfolio on a monthly basis, as tenants not paying rent, rental increases could affect our client's financial plan significantly? If so, how do we begin?
Short answer to that one is yes, there's some complexity around privacy and disclosure, but let's take that one offline. I'm happy to chat to you personally about that. But we are, one of the conversations that is happening at the moment at a much larger institutional level with some of the financiers and the banks is with property management tech plays like Proper, where we know every single data point about your property, and we can start to then predict what might happen with your property when we can start to aggregate that large data. There's a lot of banks and financial institutions very interested in that, and very interested in ways in which organizations like Proper can start to share that information to ultimately help you borrow more, help get more certainty over the skinning that kind of needs to happen off the rental amount. So traditionally banks, when we provide a rental appraisal, will take 30% off the top and go, no, we're going to assess your serviceability here. You know, they're starting to think about how can we, as an organization that is experts at renting, provide them with like real-time data flows on what properties are actually renting for. And maybe rather than taking 30% off the top, they can take 5%, or they can take it for its actual rental value. So that is a conversation that we're already having. So yes, we can talk about that further.
I might throw the question out to the next one out to the panel. So how do you scale a property portfolio given most people have an income that can service at most 1 to 3 home loans?
I'm really sorry, but I missed the first part of it. I was daydreaming. I can't read it. How do you scale a property portfolio? Okay. When I'm talking to clients at the moment, can you all hear me, or do I need the microphone? Okay. Hello. When I'm talking to clients at the moment, I'm saying because of the changes that APRA brought into the lending landscape 5 years ago and then 3 years ago, the world has changed, and a lot of people are still thinking the way that it used to be is the way that you can build a property portfolio. We saw in the past where people, young 20-year-old, would get a deposit, buy their first property, the property would grow in value, they got some lazy equity there, went back to the bank, borrowed some more money against that, and build their property portfolio. And by the time they got to 30, we saw them with 10 or 15 properties. Those days are gone now. You know, I'm saying to clients, imagine that you have one silver bullet left. The next property purchase you make, you have to nail it, because your borrowing capacity is massively reduced. And, you know, Vincent, you probably could talk about this in a lot more detail, but you've got to nail it. And buying a crap property that's not going to grow in value, and in 5 and 10 years' time is going to be only a little bit more than what it is today, it's going to set you back financially and retirement-wise massively. I'm not sure I answered the question, but it sounded good.
I just had some color on the borrowing power thing specifically. A couple of years ago, APRA introduced, basically, they have a thing called a floor rate. So even if interest rates are like 2%, they basically say we're going to assess your income and your ability to pay a loan on about 5.5%. And then they also introduced these responsible lending laws, which are in well-intentioned but have made it difficult to approve loans, because the nub of it is that a broker and a bank, both parties have to do it, basically have to not only assess your income but your expenses and make inquiries and actually check the breakdown of those expenses. It does two things. It obviously adds a whole bunch of work, but it also means that they're pushing an obligation to the bank and the broker around how much you actually spend on things. A couple of things that are probably important in that. The first is that it's based on typically 3 months worth of history. So if you do change your behavior over a 3-month period, and there's a whole raft of budgeting tools out there that can help you to identify where you're spending money, then you can actually change that number. And the things that you have, like, fixed expenses, how much you spend on Uber Eats and the Wagyu Shuris kind of case, if any of you read the news on that one, and also the other debts that you have can also massively impact this number. So you do have a fair bit of control over this number in terms of the numbers that are input to then drive borrowing power. And it's relatively easy to simulate. If you talk to a broker, then as long as you can give them the data points, they can run the numbers and say, well, if you got rid of this credit card and you stopped spending this much doing X, and you did that over a sustained 3-month period, that number would go up. The other thing worth knowing with borrowing power and serviceabilities, as the lenders call it, is that at some point they say, we don't care how little you spend, we're still going to use this number. They basically have a minimum number. So you can be the best budgeter in the world, but at some point you cap out. I think it is a really valid point. You're better off making 1 or 2 really decent property moves that are well structured from a finance perspective and well intentioned, and you have a long time frame for the property, and you'll do better than that rather than trying to amass multiple properties, have them on interest only, be massively overgeared and hugely sensitive to shocks that mean if rates suddenly change, you can't afford the property, you have to sell it at a loss because you're at the wrong point in a cycle. Infinitely worse strategy as a general suggestion. Cool.
Don't run away, Vincent. Okay. Got one more for Vincent. How often are we seeing in Sydney bank valuations at how often are we seeing in Sydney bank valuations at approval time coming in lower than purchase price, given the momentum in the market? How much individuals are overpaying to get into the market?
Ooh, okay. Some of that might be for Tim, but I'll take... it asked this question 12 months ago and you would have got a very different response, and 6 months ago the same. There's a couple of things that are the dynamic that happen at the point that you're valuing a property. Now, if you're valuing a property from a refinance, they go out and they get a valuer, and the valuer has to try and work out, in this current market, what would this property sell for? And then they overlay a bunch of other things. And they do that by looking at comparable sales. And that's the hardest thing to do as a valuer, is to work out what would it sell for, even in a stable market, let alone in a market like at the moment. And that's challenging. And 12 months ago, values were down. The valuer would go out and would say this property is worth less than what it was, because at a macro level, and for the 2 or 3 people who had to sell nearby you because their conditions changed and they lost their job, it looks like your property's worth less now. And that may or may not have been an accurate read at the time. The investment, and in the current market, it's the other way around. They have no idea, so they have to try and work on some inflated value. But valuers basically are held to account, right? Everyone sort of thinks that a valuers are come in, use the clipboard, take a few photos, and then pluck a number. They've got 4 years worth of, a degree to actually, in terms of study to actually work out how to do this. It's an incredibly challenging job, and I wouldn't wish it on my best enemy or worst friend. The thing though, in a property purchase situation, is kind of 2 challenges. If it's someone buying off the plan, then the valuers come in later in the market. And so the value that they think the property is going to be worth and what it's worth 2 years later when the property completes, it's kind of hard to get a read on. And you kind of roll the dice with that. And you kind of hope that you're buying in a market that's either flat or going up, so you don't have a shock when you eventually go to buy off the plan. But if you're just buying an established home, as long as the property that you're buying is roughly within kind of tolerance in terms of it's not a ridiculous amount, thank you, the valuer will typically take the purchase price to be the value of the property. So they'll go, well, the market spoke, right? If we didn't think it was going to sell for 900, I'm talking about a block of land 2 weeks ago I missed out on. We thought it would go for 550, but went for 900. It was an auction. It was fair. A bunch of people turned up. That must be what the value is. So that's kind of a read. Hopefully that answers a question with a bit of variation in it. Do you want to add to that?
A little bit.
Yep, please.
So there's probably 2 pieces of color I can add. If you weren't aware, CoreLogic owns a company called Valex, right? So Valex is a valuation platform, and it accounts for about 80%, maybe 85% of all bank valuation instructions. So say a mortgage broker will ask for a valuation via Valex. The valuer will go out and do it, put it back through Valex, the bank gets it. So we get a bit of an idea of how many are coming in under or over or on Val. I don't know what the numbers are off the top of my head. Apologies for that. But I do know a couple of numbers. But what I'd say is, it's really much more straightforward to value a property during a normal or a steady market for obvious reasons, right? There's no speed or momentum to the market. At the moment, you'll probably find there are more properties getting valued lower than what the purchaser or homeowner would think, simply because prices are moving so quickly, and inherently there is a lag in receiving all those comparable sales that Vincent was talking about. So fast-moving market, you can probably see a higher proportion of low vals coming in, or lower than expected vals. When prices are falling, it's the opposite. You'll generally see more valuations coming in higher than what the expectation would be. And of course, if you disagree with the valuation, you can dispute it on Valex, get a new valuation done. Sometimes it'll come in even worse than what they were expecting. Now, so it can go either way. The other thing I was going to mention, where I do have some numbers, is on the off-the-plan market, which Vincent mentioned as well. So for off-the-plan purchases, of course, you've got a contract and then you've got a settlement, and sometimes it can be a couple of years in between, and that couple of years can be seen as risk. And sometimes, as you're buying off the plan, you generally expect you're going to settle for more than you actually contracted for. That's generally the benefit of buying off the plan. But what we're seeing at the moment is in Sydney and Melbourne. In Sydney, is about 45% of off-the-plan purchases are settling with a valuation that's lower than the contract price, about 45% of them. And about 25% of them are more than 10% under the contract price, Val. So definitely some risk there, because conditions have changed substantially over that settlement period. In Sydney, it's not quite as severe. Melbourne definitely stands out. But my guess is we'll probably start to see that lifting. Remember, in my presentation, I mentioned there's about 46,000 apartments still under construction in New South Wales. Most of them sold off the plan. In Melbourne, it's about 43,000. I think there's going to be some settlement risk that comes through on those properties that are under construction yet to settle, and maybe some rude valuations coming through, which could surprise on the downside, unfortunately.
Can I add one?
Guys, this is a great tip, and it ties together what both gentlemen just said, and I think it's really important if you're looking to buy something. We're seeing this in our buyer's agency business a lot at the moment, and this is really interesting. If you overpay at an auction, let's say you're at an auction and you overpay $200,000 for that property, when the valuer goes out on Monday morning for the bank to value that property, they're going to say it was a competitive auction market process, right? So there was a bidder right at your heels. So had you not overpaid by 200, someone else would have overpaid by 199. So the valuer will, in most cases, put the value of the property, what you paid at auction, even though you overpaid by 200,000. Now you're trying to sneer something before the auction, and you're in a negotiation. You go to the agent and you offer an amount of money before the auction. So what happens then is, if they accept it and you've overpaid, the valuer goes out on Monday morning and he says you've overpaid by 200,000, and he puts the valuation 200,000 lower. And if you are maxed out on your borrowing and now you're only getting 80% or 90% of that valuation, all of a sudden you're running around looking for 150 odd grand to borrow from friends and family in order for you to be able to settle that. So it's really important, if you're buying something pre-market or off-market, that you're really, really, really spot on with the value of it, because it is biting a lot of people, and people who have only a small deposit are losing deposits because they can't settle. So then to your point, if you are going to overpay just to get in the market, and yeah, I would always rather overpay at an auction than overpay off-market or pre-market. When we buy off-market and the valuer rocks up, we give them a list of comparables. We meet them there and give them a list of comparables of all the properties that have sold similar and at what price. Because don't forget, the valuation the valuer is using, they can't use anything that's exchanged recently. They can only use data of settled properties. And we're in March, April now. Most of the data that your valuer is using is stuff that was sold last year in a different market from what we're in today. That was free.
We've got about 30 or 40 questions that have just come through online. What I will do is just ask the audience if there's any quick questions that they've got. I'll answer. We'll ask a couple more on the laptop, and then we'll close out the evening.
I'll try to paraphrase your question. I'm not sure if I got it right. You're saying, you're asking, is the auction environment in Sydney one of the reasons why there's so much upwards pressure on housing prices because it introduces an amount of competition? That's pretty much it. So yeah, I think that's probably part of it. I mean, you can look at other statistics outside of auction markets, which are more private treaty related. They're typical selling time, days on market, discounting rates, which measure the percentage difference between the asking price and the selling price. They're also really reflective of very tight conditions in a seller's market. You know, the funny thing is auctions are really quite unique to Melbourne and Sydney as a culture. Get outside of Melbourne in Melbourne and Sydney, around 35, maybe at the moment more like 40% of properties would be taken to auction. So still see the majority are by private treaty. Go to somewhere like Perth and it's less than 2% are taken to auction. Go to Brisbane, it's like 10%. Canberra is also quite popular with auctions. So you can still see the marketplace strength outside of that auction environment. And I think going back to my presentation again, it really comes back to this disconnection between supply and demand. There's just so few properties out there available to purchase. There's so many people that want to buy. That's where that competitive tension comes from. It probably does get amplified a bit in the auction environment just because, as these guys were saying, you're in a bit of a bidding war, a bit of a frenzy. It's easy to get a bit emotional. It's easy to overpay because you know the prices are going up so quickly. If you don't get into this one, you're back to the drawing board. You've got to start inspecting again, got another building and pest inspection, ka-ching, ka-ching. So you can understand why it gets a little bit frenzied. But yeah, it's got much more to do with just the auction. It's that disconnection between supply and demand, I think, at the base.
We've got two last quick questions. One will be a one-word answer, and then one is probably a little bit longer. So for Kiril, do you stretch as far as Newcastle for buyers agents?
No.
Short answer, no. Brilliant. And the last one, which I think is probably interesting, Vincent, you said that the pre-approvals are harder to have granted. So how does this impact apartment pre-sales where the construction is 2 or more years away?
So there's a couple of, so the question I think was relating to how pre-approvals affecting people who are trying to buy off the plan. But they're kind of disconnected in that pre-approvals are difficult generally, but it's not a consistent trend. It's just some lenders who are just like, I think one of the banks, I won't name them, the stat we heard back from them the other day, and this is a top 5 bank, so one of them, out of the 100, pre-approvals that they do, only 10 of them actually end up settling. So the banks generally are saying everyone's doing a whole bunch of work, no one's managing to buy. So the pre-approval part is some banks responding to the fact that they're just not seeing good value for the amount of effort and time that everyone's going through. But there are banks who are still doing them. In terms of then using a pre-approval when you do get one to purchase off a plan, I'm not familiar or aware of any real challenges with respect to using a pre-approval to buy off a plan. You have all of the carry risk around what might that property be worth in a few years' time. I would, without it being advice, I don't have a disclaimer, but assume there's one up there. There would be an idea that if you're ultimately trying to get into the property market and holding for a long period of time, if it takes you 4 to 6 weeks to secure a pre-approval and then you're working either yourself or with a buyer's agent to find a place to have as an investment over an extended period of time, whether off the plan or not, then that time is okay. A lot of the people who are getting emotionally, hurt by not being able to get pre-approval are people who are trying to get into buy their dream home in a market that's going up and feeling like, where am I going to live and where am I going to raise my kids? So I think that's what we're seeing more of, especially in the press. Cool. Hopefully that answers the question.
Amazing. We'll wrap up the evening there. I know everyone's probably getting a bit of property investor fatigue. I was sitting in the room for over an hour and a bit. So first of all, I'd like to thank Vincent, Tim, Kiril and Ash for speaking this afternoon or this evening. There is probably another 10 or 30 questions that are still coming through, so we'll endeavour to answer them as best we possibly can. The guys are going to hang around for a little bit longer just to see if I can answer any questions out in the foyer. There's some drinks to finish up the evening. So from myself and everyone on the stage today, thank you for coming. Thank you for tuning in. I'd love to see you next time we're here in Sydney itself. Thank you.
Thanks, guys.
Thank you.